Welcome to the Silvercrest Bohr Studios. I'm Rick Hough, Chairman and CEO of Silvercrest Asset Management. And this morning, we're going to have a quick catch-up with Robert Teeter, our Chief Strategist at the firm. Rob, a lot of news today. It's all about tariffs, turmoil in the markets. I actually haven't even looked this morning. I kind of don't want to. We'll let it settle out. But I'm curious, what you're seeing and what you're thinking. We'll move on to other topics after we deal with that.
Yeah, sounds great. I was just thinking we have to start meeting under better circumstances sometimes. I think our last podcast was also when markets were down, which they are right now on the day and on the year. Although looking back over the past year, there's still positive returns over the last 12 months. So important to always insert that context
That's
a little bit
point.
of the timing. As it relates to tariffs, a very complicated issue. We got a lot of information yesterday. For me, it sort of falls into two pieces of the puzzle falling into place on tariffs and trying to understand, what is the intent of the policy. And I think we got two signals yesterday. We got one signal, perhaps not as positive, that part of the intent of tariffs is to narrow the trade deficit with various countries. That's a process that could take some time, could insert some uncertainty that might last for a while. And as we all know, markets don't like uncertainty. The part of the puzzle that's perhaps easier to solve is that we got the tariffs described as reciprocal. And that sort of implies that perhaps there's a door to opening to negotiation, and that if today indeed turns out to be sort of peak tariff day and we get some negotiation from here and the issue becomes less and less pronounced going forward, that could be a positive for markets. So sort of two conflicting signals going on there, and it'll take a little time to see what happens. I think the big signal will be, are there any deals announced in the next few days or weeks? And if so, I think that gets us back on positive
it seems
footing.
like there may be an argument in the administration. People who want to have a flatter basis for trade, right? Let's make it fair, lower tariffs in general as a negotiation. And then those who are targeting explicitly the trade deficit. One may be positive, one could be negative. The flip side of the trade deficit, of course, is a surplus in the current accounts for the United States. Those are investments in the United States. Which way do you think this is going to cut? Do you have a view yet?
It's really interesting. I do get the sense, and it's really just a sense that there may have been some conflict leading into this of which way to proceed. And the path chosen was to sort of take both paths and communicate both messages, which works for the time being, I suppose. But eventually that will need to get reconciled. And I think we'll tell in the next few weeks, depending on what actions are forthcoming after this, sort of which path we go down. And if we end up in a path of a lot of focus from the messaging on narrowing the deficit, maybe retaliatory actions, a willingness to not negotiate and to keep these in place until deficits compress, then we might be in for an extended period of choppiness. If we start to get more messaging in the direction that I think I thought it was going in earlier in the year, which is, this is really opening the door to negotiation. Here's where we're starting. Let's go through a process. Let's see where we end up. If we get signals that that's the case, then this might well be peak tariff day and things could improve from there. So I'm sort of hoping it goes that way, and I think the signals are that it might be, but it's a little too early to tell.
This is all a bit basic, but basically the markets are choppy because they don't know how to discount the future in terms of what's going to happen. Is that right?
Absolutely.
Until it settles out.
Absolutely. And I think that's been a message of ours from the beginning of the year, which is you entered the year with high valuations. That sets a really high bar for what type of news might be forthcoming after that. And the news has been a bit erratic, at least in terms of market perception. It's created some uncertainty, and that's collided with those high valuations, and hence we have this choppiness that's been going on for most of the year so far.
Right, albeit the market is up year over year,
as
you pointed out. Some news that may lean towards negotiation. I did see this morning that the Ontario Premier talked about if it were up to him in Ontario, they would remove any of the tariffs that were problematic and start negotiating. Likewise, the president of Mexico actually had some very constructive comments this morning about negotiation.
Those are the types of positive signals that I think we want and need to see. And so I wouldn't be surprised at all if over the course of the next week or two, you get some announcements of these negotiated deals and things start heading in a more positive direction. That's the hope, and I think that's something that's very realistic. It also comes back into play of, sort of what's the administration's view of market response. And in the past, it's been pretty well perceived that the administration does view the stock market as an important temperature gauge or barometer of what's going on. And I think that probably comes back into play as well, of wanting to keep, a strong market is coincident with a strong economy. It certainly helps. And so I think they will be responsive somewhat to how markets are perceiving the news.
Although it did seem the Treasury Secretary was not displeased to see the market coming down a bit.
Yes, that's correct, and I think that's part of what perhaps the messaging story has been. Is this is a one time rip the Band-Aid off, take the pain, and move forward from there. And that also reinforces the view that if we do get some better news on the tariff front going forward, better as perceived by markets, then markets are likely to rally from there.
You recently had your economic review come out earlier this week. I commend that to those listening. You can find it at silvercrestgroup.com or LinkedIn or Twitter, Silvercrest Twitter account. Rob, you noted that inflation has come down to about 2.8%. In that, what are the implications now?
Yeah, very complicated picture. So clearly the tariffs will increase inflation. The question is by
1%.
how much? Most of our calculations and those of others would point to the tariffs yesterday having the potential to increase inflation by 2% or more, but that's with no adjustment. So when we start working through, who's making price adjustments, are there substitutions, et cetera, as a rough back of envelope, maybe 50% of that. So maybe a 1% increase from where we are. That puts the Fed in a difficult spot in terms of wanting to respond to any economic weakness that might emerge while you might have inflation heading higher. The Fed's been pretty clear, though, in communicating that tariffs are a one-time inflationary burst, and they might be willing to look through that if there aren't other signals of a continued problem with
and
inflation.
on that, we have inflation, we have growth questions, and both influence the Fed. 10-year was at 4.3%, headed towards 3%. Now it's all volatile and up in the air. At what point will it give the Fed more firepower?
I think it's starting to. If you get this market reaction, the Fed would never admit to being tuned into what's going on in markets day to day, but there is an important wealth effect. And so one of the ways that we model out potential consumer growth is wages plus payroll expansion. And I think that's classically the way that the Fed might look at it as well. But when you layer in other things like uncertainty in markets that might increase the savings rate or apprehensiveness to spend, when you layer in a negative wealth effect as you might get from markets, that all points to slower growth as well. And so we've been on a slowing growth trajectory. And if the Fed starts to see some of these signals that we might have even slower growth, and certainly if we get it in some of the numbers around payrolls or other things in coming months, I think they'll be very quick to respond to the economic side of the
Wages
equation.
were up what, about 4?
Around 4%.
Yeah, 4%.
Yeah.
Wow.
And payroll expansion, a similar number, and so you sort of back inflation out of that, and you have a pretty healthy consumer backdrop, albeit not as healthy as it was a year ago, as we head into some of this.
With regards to that growth trajectory, it seems like we're getting conflicting signals from the Fed itself. You look at New York versus Atlanta. What do you have to say about that?
Yes, those are the two most prominent models. The Atlanta model is based on a series of correlations that basically try to predict GDP, and the big distortion in that model was the imbalance in import-export. There was a lot of importing going on ahead of the tariff announcement. That is a negative to growth, and the Atlanta Fed GDP number posted a negative reading, which caught a lot of people's attention, and rightfully so. There are some other signs of slowdown. The Atlanta Fed went through some adjustments and calculated some other things to offset some of that effect, and it came up with a very slightly positive number, which I think is probably closer to reality. New York Fed's a little bit more of a real-time metric that's been a little bit more positive. We track a lot of spending numbers, mobility numbers, visits to restaurants and things like that. Nothing looks fantastic. Nothing is accelerating, but nothing is in a recessionary configuration as best as we can tell right now.
And of course, we won't know until the recession is over,
Yeah.
usually.
Right.
So let's move beyond the immediate moment, the noise with trade, the politics, which we could obsess over. And I think, frankly, there's too much obsession over politics and the immediate noise. Neither we nor our clients invest for the next quarter, let alone the next year.
Right.
There's very substantial assets at stake for the long term.
Mm-hmm.
Let's look out further, 2 years, 3 years, something like that. Maybe 3 years is a nice horizon.
Yeah.
What you're seeing, in particular, you spent a fair bit of time talking about productivity and the potentials for AI and robotics and other things.
Yes, you read my mind. That is exactly what I was going to reference. And we do take a 3-year forecast horizon. We find that correlates well with fundamentals rather than noise. And
not just fundamentals, but your ability to look beyond the noise and see the bigger trends in not just the marketplace, the
Yes.
weighing machine, but in
Right.
the economy at large.
Yeah, absolutely. And so we are indeed very excited about the potential for productivity gains from AI and from robotics. Both are becoming much more widely used. Both are coming down in cost, which will enhance adoption and make adoption much more broadly implemented. It's not just a big company thing anymore. Everyone can access these tools.
Absolutely.
Even in robotics, where the cost of robotics had been prohibitive, it's come down quite a lot. There are a lot of firms that rent robots and such. So there's a lot of opportunity to improve productivity across industries. And we're starting to see some signs of that. I think it's a very rich opportunity set for profit margin management. And it's something that once we get into a phase of the noise of politics and all is quieted down a bit, perhaps, or is in the background, we recognize that we're in what is likely to be a slow growth but not negative growth economy. The focus will shift to where are these gains coming from, and I think they're coming from productivity, and there's a lot of potential there.
Yeah, just an observation. I do find it interesting that we see a lot of potential in productivity, including robotics. All new efficiency and productivity stresses and has implications for labor.
Yes.
At the same time, we're trying to support higher
Yes.
labor wages by onshoring manufacturing. These are two trends that are kind of pitted against each other.
Yeah, very much a conflict there, and I think one of the first times that really came into clear focus was towards the tail end of the pandemic cycle, the boom part of the cycle, when there were a lot of new contract negotiations, labor
Right.
unions and things, and increased wages. That's good for the worker, but at the same time, with the productivity trend, you may have fewer workers employed. So that's something we'll be keeping a very close eye on, is that interplay between wages, number of workers employed, and productivity.
You gave an astounding statistic which involved the Pennsylvania state government. You
Yes.
don't expect government to
Correct.
to pioneer great efficiencies, but what was your example there for AI in
So
Pennsylvania
I happened
already?
to be in my home state and catch a news article that the governor of Pennsylvania was talking about a pilot program implemented with Carnegie Mellon and giving some tools to government employees who ended up saving, I think it was something like 8 hours per week of their time in this trial, which is a very significant number. And happens to match with some of the other thorough research that we've seen on the potential for productivity gain from these tools. So I think implemented correctly, there's a lot of potential there.
That's great. So what does that mean then for your 3-year horizon, particularly for the economy driving earnings
Yes.
and therefore the market over that period of time?
Yeah, so we're looking for a slow growth economy. So perhaps that's 2%. It might be a little bit lower in the short term as we work through these disruptions and uncertainties. But long-term trends are around 2%. That seems to be where the U.S. is headed.
By long term, you mean since 2009?
No, very
10?
long term. Even going back farther than that. So there are periods when it's hotter and colder. There are areas where it's averaged around 3%. But over very long periods of time, we think the trend line eventually ends up at around 2%,
Okay.
based on population growth and productivity and other sort of longer term influences
Right.
on growth. That number is pretty healthy for profit gains. Historically, that would put you in mid to upper single digit
Meaning
earnings gains.
8-9%?
7, 8, 9%.
Yep.
With the potential for profit margin improvement, you could have something higher than that. So the way we weigh it out is sort of base case scenario, 1.5 to 2.5% economic growth, high single digit earnings gains. That's a pretty good opportunity set. The economy could be a little slower in the short term. That might bring it down a bit,
Mhm.
but the productivity gains could boost profit margins a bit more. That gives you a bit of upside to it.
We live in a global world.
Yes.
Silvercrest has increasingly been involved with clients and institutions abroad.
Yes.
We have significant capabilities, including an office in Singapore in different time zones. What are you seeing now for the implications of what's happening in the U.S. economy for those foreign markets in terms of investing,
Mhm.
right?
Well, I think there's a healthy change in that for the past couple of years. Let's say you've had a very strong focus just on the U.S. as being the only source of growth and opportunity for earnings and capital appreciation. And I think some of this reset has been an eye-opener to maybe let's look around the world a bit. And there are some great companies out there that perhaps are trading pretty cheaply because of where they're located. And so I think we're getting a little bit of a rebalancing effect for something that had been a one-way street. And now we're opening up our eyes a bit to you can be diversified. Longer term, I think the U.S. still has some demographic advantages that are very favorable. in terms of population growth. I do think some of the productivity trends will unfold quickly here. So the U.S. is still a very compelling market for investment over the long term, but some of this rebalancing has been long overdue and I think welcome.
Do you think that will stick with regards to the outperformance of some of the international markets in more recent history?
I think it will in the near term. I think this adjustment is still ongoing, and with some of the noise that is likely to continue to play out in U.S. markets and some of the volatility, that readjustment phase will continue for a while. But long term, I think
Right.
we settle back into something.
And of course, to the extent that our trade deficit is decreased,
Right.
that likewise means less capital account
Right.
flows, which is less supportive of
Yes.
assets here in the United States,
Absolutely.
and will go to the benefit abroad, I think.
Yes. No.
So does that make sense?
Yes. Absolutely.
Contrary to the news that is around big, large cap companies that we
Mhm.
constantly read, and we do because they're easy to cover for the news media,
Yes.
right? We have to look at where people's attention is drawn just
Right.
because it exists.
Yes.
But in reality, most economic growth in the United States or abroad is driven by small entrepreneurial companies, small cap companies.
Right.
Any chance for a change in the regime there?
I think there is. I mean, a couple of things to highlight. So one thing that was really encouraging, again, towards the later phases of the pandemic, was the massive increase in startup of new businesses, and that just points again to innovation and change, and as you point out, growth coming from smaller entities and smaller companies. That's really encouraging and exciting. Small cap as an asset class has a couple of challenges. One is that not all of the universe is comprised of quality companies. There are a lot
Right.
of negative earning companies in the small cap benchmarks. But that said, I think there are a few catalysts that are probably delayed by the current noise in markets and will eventually get back on track. And one of those is the M&A cycle, which has been long anticipated. It's not likely to reaccelerate on a day like today when you have a lot of political noise and change, but eventually that will come back into play. And then the theme that we were talking about with productivity and profit margins, that will spread to smaller companies. As they adopt
Mhm.
more of these tools, they'll be on more even ground with large cap companies and start to see profits improve. And I think
In
that
other
will
words,
be
it
exciting and
flattens the
encouraging.
competition.
Yes, absolutely.
Yeah, makes sense. Any last thoughts before we wrap up today?
I think just a great reminder, as you pointed out earlier, to stay the course and look out over a longer term and not get too hung up on what happens each and every day.
Great. Thank you, Rob.
Thanks, Rick. Great to see you.